afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and welcome to another Barometer Readings webcast. Joining me today, as always, is David Burrows, our Chairman and Chief Investment Officer here at Barometer. And on today's webcast, we will be pleased to provide you with a brief macro overview. And of course, at the tail end of our conversation, be happy to address your questions. You can ask those questions easily via the Q&A or the chat on the Zoom link. So don't be shy, ask those questions. And with that, I turn the conversation over to the one and only David Burrows. Good afternoon, David. I hope you're having a wonderful day.
Pamela, I'm having a fine day, but it's not looking so good outside here in Toronto. It looks like it's going to be a bit of a mess tonight. So,
I hear there's a snowstorm happening as I speak.
yeah, I may not be going too far tonight. Thanks everybody for joining. We're a week into the year, and I'd love to say that Santa Claus sent us a wonderful gift, but the first week of the year was a little bit choppy. Certainly not to be unexpected given the run up we had right up into year end. Some big stocks outperformed a lot over the course of the year last year, and so certainly some investors choosing to sit through year end before doing some portfolio rebalancing. We talked last week about some shifts in themes, pick up in the value theme versus growth. We'll talk a little bit about that today. Talked a little bit about the average stock doing better, the equally weighted S&P. But lots of things to talk about. And as always, we'll just start sort of right from the top. We continue to believe we're in a structural bull market that started in 2013. Generally, sort of 3-4 steps forward and 1 step back. It doesn't mean we don't have corrections, but it means we have a tailwind. And I think it's really important always to understand what the structural backdrop is. When we look at the last 2 structural bull markets, we can see that while there were pullbacks, the market basically stayed above this rising 200-week moving average all the way along until ultimately it didn't. And then, of course, we were in a different kind of market. We were in a secular bear market that lasted from 2000 to 2013. Market made no progress. Cash flow for the average company in the S&P quadrupled over that period. Value built. Stocks became very unpopular. And then in 2013, markets broke out. If we take a look at the S&P 500 over the last year, we saw a series of higher lows starting in October of 22. We broke the downtrend in February last year. February last year. We tested in October. There was about a 10% pullback in the S&P. Breadth models turned positive in the very first week in November, and they've been positive ever since. You can see here we are a whisper from the highs. We're about 0.3% away from all-time highs. And when we go back to this picture here, you can see, look, anytime you went through a cyclical bear market, it tended to be once you got out, you had 2 to 3 years of very strong returns and low volatility. So we continue to see low volatility readings. We can continue to see pretty good breadth data. And I would say we're awfully darn close to breaking out to new highs. So the goal is to be structured with a portfolio that's focused in groups that people show that they are caring about, where there are flow of funds being put to work. We don't have to be everywhere. We got to pick our spots. Now, the fact is we are going to see corrections, on average. You see 3% dips over the course of the year. I think the NASDAQ was down 4.5% in the first week of the year. Not uncommon. You're going to tend to have 3-5% corrections over the course of the year. We're probably going to have 10% correction over the course of the year. But the net of it is we come into the year with pretty strong shock absorbers. When breadth models are positive, meaning the percent of stocks in uptrends has been expanding, it means the market can absorb some bad news and it can absorb some selling. So just quickly, there's the NASDAQ. NASDAQ did make new all-time highs and certainly pulled back 4.3% in the first week of the year. We've bounced the last couple of days. We'll see whether that continues on. Certainly some big stocks have made good moves. NVIDIA made a new all-time high after consolidating over the last 3 months. NVIDIA is cheaper today than it was 3 months ago, given the fact it's been growing its earnings at 100%. We talked last week about the equal weight S&P after a long period of underperformance, having made a turn in the month of December, now trading above rising moving averages relative, to the QQQ. That's the NASDAQ 100. That's a shift. And it's important to recognize shifts because we have to be able to reposition the portfolios from time to time. Now, US stocks over the last few years have had really historic outperformance versus global equities. And it's been a great place to be. But let's be clear, it doesn't go on forever. It tends to be that US stocks outperform for 10 or 12 years, and then you get a shift where global stocks start to perform a little better. Now, interesting, the TSX here in Canada has underperformed for several years. And if we go back over the last year after the decline into the October lows, we banged our heads a number of times on this downward sloping trend line until ultimately in December, we clearly broke through. Now, I get it, people being frustrated with the Canadian market, certainly being here, we live with it, but I want to put it in a bigger context. Okay. 2008 through 2021, 13 years of going nowhere. When it did break out in 2021, as global stocks started to do a little better, our market tends to be a little bit more like global equity markets, higher financials weight, higher industrials weight, higher materials weight, rallied sharply and then consolidated through the Fed's tightening cycle, but in the last 2 months has broken above that resistance. I think that's sort of important. Now, part of the reason that I think it can do pretty well is we're looking at a market that's pretty reasonably priced. If we go back to 2005, you can see the range of price earnings ratios. TSX currently is about 13 times earnings. Now, I get it. We're discounting some risks to the economy. That's for certain. But it's not an expensive multiple to start with. When we look at the Nikkei went nowhere from 1991 until 2021. And look at this, we're breaking out of this range. This is as of today, closing at a new high. That's important. When we look at India, going nowhere from 2011 through 2021, breaking out, consolidating through the tightening cycle, and then following through. Okay, that's a shift. That's a big global market coming to bear. Now, if we compare the MSCI World ex-US versus the MSCI US, you can see the difference in PEs, 13.6 times versus 20 times. In fact, it's about as big a disparity between the two as we've seen going back over the last 22 or 23 years. So important to recognize shifts. It could be that global stocks are ready to outperform. Certainly some major markets did last year. We're seeing real interesting price patterns in Latin American markets, in Mexico, even in the European Euro Stocks 50. So interesting, something just to keep an eye on, want to understand the big structural backdrops. This is one of the reasons we took our Canadian equity mutual fund, or our equity mutual fund, and converted it to a pure global MSCI ex-US mandate as of the end of the year. The one market that is not performing well continues to be China. And this is difficult because a lot of people focus on ETFs like the EEM that have a significant China weight, which certainly is an anchor. This is a market that we're avoiding. It's one actually we've been short in our macro portfolio and one that we watch because it's a big market. But certainly this is about the weakest market on the planet currently. Moving into the bond market. Generational low in interest rates in 2020 after declining from 1981. Very significant shift in the 10-year yield. We've seen a number of consolidations along the way. And recently, we saw yields come down from 5 to just below 4. Now, I'm not a bond expert, but I don't like to fight trends. Clearly, it looks as though we have shifted from a very long-term downtrend in rates to a longer-term uptrend in rates. And when that begins, we know it can go on for a long time in fits and starts, and it doesn't go straight higher. But at 4% yield to put your money out for 10 years, at a time when US government has more debt than it's ever had in the past. Not the most attractive proposition. Now, something is for sure different. When we go back to the late 1970s and look at all of the major drawdowns in the bond market, we're still down 17% from the beginning of the drawdown in August of 2020. That is different than the rest. And I would say this is different than any other move higher AB yields we've seen since the 1980s. So we want to respect that. Clearly, stocks continue to outperform bonds. This is the SPY versus the broad-based aggregate bond index in the US. Stocks just made a relative new high as of today. So big picture, we like stocks over bonds. Big picture, we are much warmer to global stocks than we have been in some time, and that includes Canada. Moving back to yields. The last time we saw yields shift and start to work their way higher, you would think, given the rhetoric of people being concerned about rising rates and what that means for stocks, that stocks would have done poorly. But if we take a look at stocks from 1950 through 1966, they went up 15.1% a year, and government bonds went up exactly what inflation went up. So a 0% real rate of return. So in a reflationary world, stocks tend to be more attractive, and certainly dividend growth stocks tend to be even more attractive. Let's move on. Commodities. Commodities reversed a bear market that started in 2008, reversed up in 2020. Have had a couple of consolidation ranges. Certainly over the last 4 months, it has been consolidating, but we can see the long-term moving averages now moving smartly higher. This group is in an uptrend. But you wouldn't know it based on positioning. Positioning in commodities is the lowest it's been since the worst point of the financial crisis in 2008. This is investors positioning for what they think is a recession, but the way that commodities are behaving is not commensurate with a recession. So I like to take a market signal. Market's telling us right now, between stocks and commodities, not likely that we have a deep recession in front of us. It's possible that the bear market leading up to this point in stocks gave some compensation for that. But I think there's some mispositioning investors in commodities versus what's happening in the real world. Just moving on quickly, other macro assets, Bitcoin continues to improve. They look at the last few bear markets, 2011 down 80%, and then a meteoric rise. From 2014 to 2017, you had a bear market that lasted 1,200 days, down 86% at the worst point, and then a pretty significant meteoric rise. A bear market that lasted 1,100 days and down 84% between 2018 and 2021, and a very significant rise. So now we've been 812 days. We've not taken out the highs. Certainly it looks as though the low is in back here at 15,000. We're closing in on the approval date for ETFs in the US. My guess is that's going to broaden the demand. And I think it's relevant that when we compare how Bitcoin is acting versus the equally weighted S&P, every time you broke these downtrends, it was significant. We'll see whether this one is, but certainly, you know, this group continues to act well and probably under. We do own Bitcoin through GBTC, the ETF in the US, which is more of a call on Bitcoin. It's $13 billion in assets. They're likely to have some success when Bitcoin ETFs get approved. And we do own some Ether through an ETF here in Canada. Okay, so where should we be positioned? We think our job at Barometer is to do three basic things. The first is to focus portfolios in areas of market strength. I think when people hire a manager, they expect the manager to find the themes that are set up to be revalued over the course of an economic cycle. So here we are about to make new highs in the S&P. We got to make sure we're in groups that people care about. And that could be specific sectors or themes. It could be specific geographic regions. It could be specific asset classes. We don't have to be everywhere. We got to always be watching for new signs of strength. and frankly, signs that certain strong areas are rolling over. And then third, in the absence of leadership, have a willingness to be on the sidelines. So for those that follow, there are times when we do own significant cash weights. It is a tactical approach. We don't have a lot of cash right now. Three basic pieces to the strategy. We've got a top-down process that aims at finding parts of the market that are seeing net inflows of capital. That's expanding breadth. We've got a bottom-up process aimed at finding securities that are good getting better, where they're fundamentally sound and showing accelerating improvement, second derivative, showing prices doing what they should be doing and financial characteristics that would support a revaluation. Where we can find sectors and themes that are seeing net inflows of capital, and then identify securities that fit within those themes that are fundamentally sound and technically attractive. That's where our portfolio lives. Very straightforward. The third important piece of the strategy is a very disciplined selling strategy, because frankly, people make their biggest mistakes in what they don't sell rather than what they buy in the first place. The top-down model is focused on trying to find areas of the market that perhaps have been out of favor, but show expansion and breadth, meaning of over time, more and more stocks start to perform well, buying spreads to more and more issues. When that's taking place, there's no bear markets in history that show that characteristic. Now, late in advance at some point, while the leaders carry on, the weaklings will start to peel away. And we focus on breadth because while we may be fortunate enough to own the leading stocks, we want to know what the weaklings are doing underneath the surface. Because if they start to weaken and deteriorate, sooner or later, if the sell-off gets bad enough, it comes back and gets the leading stocks. So our job is to identify areas of improving breadth and move away from areas where breadth is deteriorating, and we measure these models daily. The stop loss process is aimed at making sure we don't stay in a difficult position. When we put on a new position at say $10 a share, we enter a stop somewhere below the market price, where if sooner or later we breach that level, we go to the sidelines. We've used up our risk budget. If positions work out as we hope or expect, we will steadily ratchet the stop losses up and behind them. That does two things. The first thing is it makes sure the little mistake doesn't turn into a big one. But the more important thing is it allows us to stay in the winning positions as long as they continue to perform. Now, over the last 12 months, there's lots and lots of times I got concerned about how expensive NVIDIA was. But we followed it along with stop losses. And sometimes the best stocks just wind up doing way better than you ever thought. And that's NVIDIA. So every year out of 20 positions, 2 or 3 make a big difference. You want to make sure you've got a process that allows you to stay in them as long as they continue to perform well. So let's talk about breadth. In October, all of these indicators were negative or red. As it sits right now at the market level, in the NYSE, the percent of stocks in uptrends has been expanding steadily since October, where we started at 20%. And we're currently sitting at 64%. So 64% of stocks in the NYSE are in clearly defined upward price trends. And we use point and figure charts to define those trends. In Canada, breadth has been improving. And importantly, globally, breadth has been improving. Now, those are long-term indicators. Our shorter-term indicators move around a little bit. And you can see that the percent of stocks trading above the 50-day moving average in the US moved down from about 85% to about 78%. It still means 80% of stocks approximately are trading above the 50-day moving average. That's a big number. It means it's a broad-based advance. In Canada and globally, percent of stocks trading above the 50-day has not pulled back over the last week the way that we saw in the US market. Percent of stocks with positive weekly momentum pulled back over the last 2 weeks in the US. That just means upward trajectory stalled. The percent of stocks making new highs versus new lows remain green, and percent of stocks trading above the 150-day moving average in Canada, the US, and globally all has stayed positive. So what does this mean? When the breadth indicators are positive, it's like shock absorbers. The backdrop of the market is constructive. It means the market can tend to absorb a lot of bad news. So we watch these daily, Should these indicators shift down, it causes us to be more cautious and tighten up our stop losses to stop putting on any new positions. But right now we have a green light. And right now there's lots of things to do. When we look globally, I take all of the countries and put them on a distribution curve based on the percentage of stocks in uptrends. The ones in green are showing expanding breadth. The ones in pink are not. So pretty clear picture. China and Hong Kong, worst markets in the world. Indonesia, not much better. However, forgetting about China for a moment, India, 70% of stocks in uptrends. Israel, 70% of stocks in uptrends, given what's going on. Japan, solidly improving. Brazil, solidly improving. Europe as a whole, solidly improving. US, solidly improving. Canada, solidly improving. This is a broad-based equity rally. Now, it doesn't mean there won't be local problems, but it does mean that the equity asset class has a tailwind all over the world, not just the US. The average country has 47% of their stocks in uptrends, about 1 in 2. But you can see the strongest ones at the far end of the right are global markets. So very interesting. That's a change. When we look at the US bullish percent readings, this is as of today. We've been rising since the end of October. The way we measure these in time, we mark 1 through 9 is January through September, A, B, C, October, November, December. So you can see we declined through August, September into October. In the first week of November, the percent of stocks in uptrends reversed. We went from 28% to 34%, and steadily, day by day, the percent of stocks in uptrends measuring net new buy signals from point figure charts against net new sell signals has steadily been rising, and we now sit just around 64%. Importantly, that took out the high from July, and we're very close to taking out the high from February of last year. Now you can see this reading can get to 80%, and it can stay there for a while. So we've got a market that certainly has a pretty good footing. When we look at the point and figure price chart of the S&P 500, this is the reversal up at the beginning of November. We pulled back, we made a new high, we pulled back and held the low, and we're in this range. I would look to expect to see this ultimately break out at 4,800, and currently support is down here at 4,700, so 4,680 would be something to watch. Now, in truth, the first sell signal in an uptrend or the first lower low tends to be false. It tends to be a shakeout. So I would give that some room and watch for the bullish percent readings to change in the US, but right now both are positive. We look at the NASDAQ, no sign of a major shift. And when we look at the S&P equal weight, you can see that after many, many months of not being able to get through this level here at 6,300, went back to April, we eventually broke out at the end of this past year. So the broad-based indices, both from a breadth perspective and from a price perspective, pretty attractive. Global stocks, pretty attractive. Let's look at the sector work. Now on the week, the average sector moved to the left 2%. What does that mean? It means that the percent of stocks in uptrends on average moved from 52% to 49.1%. Now, every sector is different. They don't all behave the same. What changed to the worse? Software got a little weaker. You see small letters means it reversed into a column of zeros, breadth contracted. Textiles, that's apparel. Semiconductors, restaurants, and builders. So we have 3 consumer groups, 2 technology groups. The other group that had never reversed back up since October was energy service. But you can see the rest of the sectors are in a column of X's, which means red has been expanding. The ones in green have strong relative strength versus the market. Strongest groups: banks, steel, insurance, Wall Street, housing, forest products, savings and loans, business products, aerospace. These are economically sensitive groups. So if you believe the market gives you signals that the market assimilates all of the information that's out there good and bad, and then ultimately people make decisions as to what to do with their money, the net conditions have been improving overall. Stock leadership. So tech has been important leadership over the course of the year. Last week, we highlighted the fact that it had a sharp down move. Now, the best group in technology, despite the pullback last week, is cybersecurity. This is the HACK ETF. It's made up of equally weighted basket of large companies in cybersecurity. We happen to own a couple of names in this group, but this has been steady rising relative strength all the way since July. So this group we got to give a little room to. In the semiconductors are sloppy, but the big daddy NVIDIA made new highs. New relative strength high as of today, new absolute highs, trading at $540, broke out from this breakout level at $504. And certainly looks like it's got another leg higher. So earnings are still about 40 days away, and we are headed into the earnings period. But certainly investors are prepared to make a bet here. And look at this gap that was left behind in May. Very often gaps get filled, but the strongest gaps, what we call breakaway gaps, never get filled. And it tells you just how strong technically a company is. So this continues to be one of our biggest positions. On the other hand, let's look at Apple. This is relative strength to the S&P 500, been weakening since July. We sold this in December. And it's certainly looking weaker. It could certainly bounce here, but I don't think this is pointing to one of the leaders going forward. Now, last week we talked about financials. Financials have had a great run since October, really sharply improving relative strength. No question, extended above the moving averages, certainly could pull back a little bit, but I do think that it's a big shift. When we take the lens back, again, I always like to take the lens back. This looks a lot like global stocks. 2008 through 2021 without making a new high, that's a bear market. Make a new high and then go through a Fed tightening cycle. And then in December, broke out of that range and moving higher. I think this is a new bull market. Now, this group is definitely underowned. There definitely was a major shake in the US banks in March and April of last year. This group is definitely not expensive. We talked last week about banks. We talked about owning JP Morgan, which we owned through the year, adding in the fall Bank of America and Citigroup, in Canada, TD, Commerce, and National. And they're all doing great. Before we added those banks, we were long the insurance companies, and certainly the insurance companies acting well themselves. Now, this is the revisions to earnings for the S&P financials. Certainly, they've had a nice tick higher. When we look at the insurance companies, the biggest position in the firm continues to be Fairfax Financial. Now, I've had a few clients ask me regularly about Berkshire, and we own Berkshire. It hasn't made a new high yet. Relative strength versus the market from September through December was weaker. We own it because from a pure price perspective, it's been able to hang on. But frankly, given a choice between two property and casualty companies, two companies that invest in private equity, two companies that own private businesses, Fairfax would be our number one holding, trading better than 90% of stocks in the S&P. Moving on. We talked last week about value versus growth having made a shift. We did a little more work this week. This is courtesy of our friends at Strategas. It compares growth versus value in the S&P large cap universe. You can see growth definitely shifting. Difference between growth versus value in S&P small cap universe, definitely relative strength weakening. When we look at the Russell 1000 growth relative to the Russell 1000 value, same thing, a shift in trend. And Russell 2000, which is more small cap growth relative to small cap value, again, the small cap growth peaked in June of 2023. So there's a bunch of clues. I don't want to ignore them. I don't want to get caught focused just on the big tech stocks. That's why we've taken our tech exposure down and why our broadened portfolio looks a lot different over the last 6 months. So groups outside of tech and outside of financials, industrials continue to act well. This is VIS, which is an ETF of equally weighted industrial companies. We spent the last 2 years talking about defense stocks. We've talked a little bit about Caterpillar. We talked a little bit about Eaton Corp. Boeing, thankfully, is not a name that we own. They're having their own difficulties. Certainly, it's pulled back over the last few days. Technically, not a big deal, right? We broke out to new highs. We rallied into year end. It's pulled back a little bit, filled some gaps. Group looks just fine. Biggest position that we have in this sector is Stantec. Stantec provides consulting services for infrastructure projects in Canada, the US, and globally. They've had a great growth record. It's a company that just continues to execute, continues to see rising relative strength all year long. Materials. So it's been a little bit frustrating. It's a group that consolidated during the Fed's tightening cycle. This would be made up of things like miners, things like the aggregate producers, steel companies, basic materials, things that you need to build infrastructure or things that you need to build out new plant and equipment. Certainly broke out at the end of the year. 3 weeks now, we've pulled back into the top of the breakout. There was a gap left behind. $71 is something I'm watching for. This is FXZ, the materials ETF. I do think that there's a big opportunity here. In the materials, steel is one that I think is really surprisingly attractive. I think it's more about a shortage of supply than a strong economy. We saw some consolidation in the industry with US Steel getting bought. But again, this broke out of the range, and over the last three weeks has pulled back into the breakout point. I think the picture looks a lot like global stocks. It looks a lot like financials. It's a group that's been out of favor for a long time, breaking out to new highs. Miners are the same, broke out, pulled back over the last 3 weeks. Again, not a big deal. And forest products, again, look the same. So a lot of groups and materials continue to look really, really attractive and probably have a very, very good year going forward. Energy. So this is a battleground discussion for a lot of people. It's important to know that the energy sector fell 90% from 2014 through 2020, 90%. And during that time, there was a ton of consolidation. During that time, virtually every pension fund decided that they couldn't own energy going forward. Of course, any ESG fund decided they couldn't own it. And yes, we're moving to electrification of cars, but the truth is the world still uses oil. So we like to use market signal. We did break out, certainly have pulled back over the last few weeks. I think this is going back to the end of November. So we pulled back into the moving averages. Things I watch. Bullish percent, or the percent of stocks in uptrends, is positive. Check. When we look at speculator positioning in oil, well, it's basically at a record low. Going back over the last 10 years, there hasn't been a time when speculators had less positioning in oil. So if the trend can be positive and bullish percent can be positive and positioning is exceedingly short in the market, it's likely that maybe the speculators are mispositioned. We'll see. But at this point, we have an overweight position, but the position certainly is less than it was. A couple things that have changed. We've seen pharmaceutical really start to lift over the last 3 months. This week, JP Morgan has their healthcare conference in New York. It's generally a big catalyst for the sector. Been 3 big weeks in a row. Our one big position here would be Lilly. It's a position we've been in over the last 18 months. Just basically a play on the GLP-1 weight loss drugs. We think that that's probably the biggest market drug the world has ever known. Consumer. Consumer has not been a group that we've been so focused in. There has been a rise in relative strength since October, acting a little bit better. I think we have to pick our spots. Couple of names that we are focused in: Uber. which went cash flow positive in the later part of last year, and Shopify, which made a new high today. Now, outside of these two companies in the consumer, we are fairly defensive. We own Couche-Tard, we own Dollarama, we own Costco. These are not big luxury brands, but they are brands that seem to, all of these companies are taking market share. Last couple of things. Dividend growers. Dividend growers continue to outperform high dividend payers. I recognize that if you're concerned about the economy, you want to own defensive sectors. That's not the way the market is playing it. We know over time, since the 1980s, dividend growers as a cohort have outperformed high dividend payers, our home composite, the TSX, dividend cutters, of course, and non-dividend payers. As a rule, dividend growers have been a good cohort to focus in, especially given the fact that the annualized volatility from 1986 is the lowest for dividend growers. So this is one of the only free lunches you get in the market. So across our portfolios and the sectors we're focused on finding companies that have shown a willingness and an ability to grow their dividends regularly. So what does it all mean? When we look at the financials weight in the S&P, it's a little over 12%. You go back a month, we were 17%. Today, we're 23%. You can see we've been raising our exposure here. Technology, which is 28% in the S&P, is a weight about 17% in our portfolios, and that's been down here for a little over a month. Industrials are a little bit overweight. We've raised that since a month ago. Materials is at almost a triple weight. So we do have a sizable weight here because we think the positioning in the market is particularly light. We think that the valuations are reasonable and the price behavior is much better than you would expect, given the fact that people are concerned about a recession. Energy is an overweight, but certainly we did take it down in this most recent pullback. We have a small amount of corporate and government debt that's primarily in balanced accounts that are mandated to have fixed income. Our consumer staples weight is underweight, but it is larger than it was because we have seen strong performance out of companies like Dollarama, Couche-Tard, and Costco. Healthcare is an underweight, discretionary is an underweight, communication services an underweight, and almost no real estate or utilities. So these are more defensive sectors. They are not the best performing sectors. They are underperforming the market. More economically sensitive groups are performing better. So we think that the market is looking forward at the next business cycle. Now, there's lots of things to worry about. I got asked last week about the election. Here's another statistic. If we took any year where any cycle where the midterm year was negative, that would have been 2022. We had negative returns. The pre-election year was positive, and we talked about this all last year, and it was a positive year for markets. And the election year was positive every time since 1960, an average 13%. Okay, well, that's a statistic. We know there are a lot of elections this year. If we look at the percent of world GDP or population that's represented with elections this year, there's a lot of elections. What do governments do coming into elections? They stimulate. We know that governments have a tendency to do whatever they can do to get reelected. So while central banks have been tight, we know on the other side, there's been stimulus and there's been money being spent. Now, from a liquidity perspective, since March of 2022, we've gone from 4.7 trillion in money market funds to, as of January, 6 trillion sitting in money market funds. That means that investors have been pulling their money out of the market all year long while markets were improving, not believing that they could be strong. We know flows in January, February, March, and April are the 4 strongest months of the year for new money getting put to work, largely into things like retirement accounts. When we look at earnings expectations for 2024 are about 11% better than they were for 2023, and estimates top down from the street looking for 275 in 2025, another significant increase over 2024. Bond investors have regularly showed over the last number of months they're demanding less premium to take corporate bond risk, meaning they're comfortable with credit risk. And volatility has continued to be in a band that is commensurate with bull markets. So we watch for these signs to change, and they don't seem to be. Now, this was one more thing that I thought was really interesting this week. There's a gentleman named Martin Pring. I've followed him for 25 years. He's one of the smartest market technicians and quants there is in the street. I thought this was such an interesting display that he had. He measures the shifts in margin debt. So when margin debt starts to creep up after contracting for a period of time, and he runs an oscillator, anytime the oscillator turned positive, if you went up and took a look at what happened in the market, in every case, it was early in a new rally cycle. So this was failed. This was failed. So there's all kinds of interesting signs we have to look at. We look for risks. We look for the things that maybe we haven't considered. I think probably the biggest risk this year and next year and the year following is if China were to do something on Taiwan, which is probably one of the reasons money has been running away from the Chinese market. There's signs there that you can see that cause you to stay away, and in our case, to be short. But on the other side, we've got sectors that are behaving in ways that don't make sense given the bear's view. So we watch for changes. And if we see them in our breadth models, or we see them at the sector level, we'll make changes to the portfolios. But in the near term, it looks like we are on the cusp of beginning a new expansionary cycle. So we have to use the breadcrumbs that we follow to make our decisions. Portfolios are pretty fully invested. They're pretty focused in what we think are constructive sectors. It is hard to do well when you're going through these very choppy markets, but when you get into a trending market, that's where you make your money. And we think that we're set up to do that over the next number of months. So with that, Pamela, if there's any questions, certainly happy to answer them.
Thanks, Dave. No questions today, but appreciate your
questions?
insight. I know. I don't know what's going on. Usually we have like a deluge of questions. Everyone wants to pick your brain on what ETFs you love.
All right.
But
Well, you know what? We got I can see that all the participants, we got a great list of people here today. And we certainly appreciate everybody tuning in. If you got questions that you're too shy to ask.
Dave. Oh, sorry. Alejandro said, thank you, David.
Oh.
Well, thank you for watching, Alejandro. We appreciate it.
All right. Listen, thanks everybody for tuning in. And we'll be here again next week. And for clients, we're looking forward to having sort of annual reviews with you. If you haven't heard from us yet, please reach out. Let's set up a time and have a chat. We look forward to it. Hope you've all had a good start to the month of January.
Thanks so much, Dave.